Most people pick ETFs all wrong, but in this video, I will show you a proven framework to build a winning ETF portfolio for 2026. And at the end, I will reveal my personal allocations for different risk levels. Welcome to CrowdPick Investing, the channel where you decide how I invest real money. Here's how it works. Every week, I invest $500 of my own money based entirely on your votes. You comment one stock or ETF, share your reasoning, and the most commented ticker wins. Every trade is tracked publicly, so you see all wins, all losses, and the full portfolio. If you haven't seen the full breakdown yet, check the intro video linked in the description. It explains everything in detail. You can also find links below to videos that prove I invest exactly what the community votes for, with $500 invested every single week. Now let's talk about the best ETFs for 2026, because this is where most people go wrong. Everyone wants the best ETF, but the real mistake is picking random funds without a strategy. In this video, I will show you a simple framework to build an ETF portfolio that actually makes sense. And at the end, I will reveal how I personally allocate these ETFs based on risk level. Stay till the end because your final allocation should depend on how aggressive you want to be. Instead of starting with tickers, let's start with categories. Every strong ETF portfolio needs a core market foundation, a growth engine, a momentum layer, a reliable income layer, and diversification outside US stocks, plus a dividend layer and a precious metal layer as well. I will cover the best ETFs in each category. The first category, core US market, or the foundation. This is the backbone of the entire portfolio. If everything else fails, this category is designed to still carry you forward. This category has one job: capture the long term growth of the US economy. It's not about excitement, hype, or the next big thing. It is about consistency. Most investors actually get this part wrong. They either skip a core ETF completely, or treat it like a trading position, or constantly swap it out trying to beat the market. But your core isn't meant to be exciting, it's meant to be reliable. That's why my top pick here is VOO. VOO tracks the S&P 500, meaning you own roughly 500 of the largest US companies, weighted by market size. You are instantly exposed to technology, healthcare, financials, consumer staples, energy, industrials, all in a single ETF. Now, here is why VOO on its place as the foundation. First, cost matters more than people realize. VOO's expense ratio is 0.03%. That means you pay $3 per year for every $10,000 invested. No hidden management fees and no performance based costs. Over 20 or 30 years, that difference alone can add up to tens of thousands of dollars compared to higher fee funds. Second, it automatically rebalances winners and losers. The S&P 500 isn't static. When companies grow, like Apple, Microsoft, Nvidia, they naturally become larger portions of the index. When companies fall behind, they shrink or eventually get removed. VOO does this with very low turnover, roughly 3 to 4% per year, which reduces trading costs, improves tax efficiency, and removes emotional decision making. You don't need to guess who the next winner is. The index adapts without you lifting a finger. Third, this ETF rewards patience. Historically, the S&P 500 has delivered around 10% annualized returns over the long term before inflation. Despite recessions, inflation spikes, wars, tech bubbles, financial crisis, and yes, there are bad years. But over decades, the market has consistently moved higher as US companies innovate, expand globally, and increase earnings. VOO pays a dividend. typically around 1.4% to 1.6%, which adds a small income component even in flat markets. This is why VOO is not something you trade in and out of. This is the ETF you build around. Everything else in this portfolio, growth, momentum, income, diversification, exists to enhance returns, reduce volatility, or smooth the ride, but nothing replaces the core. Think of VOO like the concrete foundation of a house. You don't decorate it, you don't constantly adjust it, you let it sit there, quietly supporting everything above it. Later in this video, I will show you exactly how much of your portfolio should live here depending on whether you are aggressive, balanced, or income focused. Because this single allocation decision quietly determines most of your long term outcome. Now let's go to the second category, a growth engine. Now it's time to turn up the growth dial. If VOO is the foundation of your house, this category is the engine room, the part designed to make your portfolio grow faster than the market over the long term. This category is all about companies that reinvest profits instead of paying them out as dividends, which allows them to expand faster than average. My primary ETF for this category is VUZ, Vanguard Growth ETF. Why VUZ? VUZ is specifically designed to track large cap US growth stocks. That means it favors companies that consistently grow earnings faster than the market, invest heavily in research and development and innovation, and capture market share in dynamic industries. Here are the key numbers that matter. Expense ratio 0.04%. That's just $4 per $10,000 invested per year, almost free compared to actively managed funds. Top 10 holdings account for 55 to 60% of the ETF, including Apple, Nvidia, Microsoft, Amazon, Alphabet, and Tesla. It also offers a small dividend yield of around 0.5 to 0.6%. Dividend is minimal because this ETF prioritizes growth over income, and it swings more than the overall market, but those swings fuel growth. How this ETF behaves in bull markets. VUZ often outperforms VOO by 3 to 5% annually because the largest growth stocks rise faster than the average S&P 500 company. In bear markets, it also tends to fall harder, sometimes down 25 to 30% in a severe downturn. But in those years, VOO was also down 20 to 25%. These are extreme cases, but it has always recovered soon. Over the long term, the extra risk is rewarded, making VUZ ideal for the growth engine portion of your portfolio. Think of it like adding turbo to your portfolio. It increases potential output but comes with more speed bumps. It has currently 51% of holdings in technology sector. This is why growth ETFs like VUZ can outperform the market when innovation and AI trends are strong, but lag when value stocks lead. So let's look into the key takeaways. VUZ is not about short-term safety, it's about long-term growth. Volatility is higher than your core, VOO, but over decades, this is the engine that drives superior returns. Combine VUZ with VOO and you balance stability with growth potential. Later, when I reveal the portfolio allocations for different risk levels, you will see exactly how much of your portfolio belongs here, depending on whether you are aggressive, balanced, or income focused. The third category is momentum engine. This category exists for one very important reason: to follow what's working instead of guessing. While growth ETFs focus on companies with high earnings potential, momentum ETFs focus on stocks that are currently leading the market. Instead of betting on a single sector or theme, this ETF rotates automatically into the strongest performers, capturing trends without the emotional mistakes that plague most investors. My pick here is SPMO, S&P 500 Momentum ETF. How SPMO works. SPMO selects roughly 100 stocks from the S&P 500, that have shown the highest relative strength over the past 6 to 12 months. Then it rebalances twice per year, ensuring that underperformers are replaced, leaders continue to get exposure, and portfolio adapts without emotion. Think of it like a mechanical trend following engine. It does not care what the news says, what analysts predict, or what social media hype is trending. Let's look into the key numbers and metrics. Here is what makes SPMO actionable. Expense ratio is 0.13%, that is $13 per $10,000 invested per year. Number of holdings around 100. Concentrated enough to capture leaders, diversified enough to avoid single stock risk. How it behaves in different markets. Bull markets. SPMO tends to outperform VOO annually by sticking with market leaders. Bear markets, it can underperform the core because momentum stocks often fall faster in downturns. Sideways markets, returns are more mixed. Some leaders lose steam, but the rotation helps capture short term trends. In other words, it enhances returns when trends are strong, but never replaces the core, which is why it sits on top of VOO plus VUZ in the portfolio. Why this ETF is valuable? This is emotion free trend following. It eliminates the common mistake of selling winners too early or chasing fads. Adaptive exposure. Leadership changes over time, and this ETF automatically rotates into the top performers. Complementary to growth. While VUZ focuses on fundamentals, SPMO focuses on price momentum. Let's look into some key takeaways. SPMO is not your foundation, it's your engine that accelerates returns. Expect higher volatility than VOO or VUZ, but that volatility is the fuel for potential outperformance. When combined with VOO or core and VUZ or growth, it enhances returns without taking unnecessary sector bets because it automatically adapts to the leadership in the S&P 500. Later, when I reveal the portfolio allocations for aggressive, balanced, and income focused investors, you will see exactly how much of your portfolio should be allocated to SPMO to maximize growth while controlling risk. If you are enjoying the video, please consider subscribing to the channel. It helps support the channel and allows me to create more content like this in the future. Also, don't forget to like and share. The fourth category, dividend and cash flow. Now that I have talked about growth and momentum, it's time to balance the portfolio with income and stability. This category exists for one key reason: to provide cash flow and reduce portfolio volatility, especially during market pullbacks. Dividend paying companies tend to be mature, profitable, and resilient. They are not chasing the latest trend, they are focused on steady profits and returning cash to shareholders. My pick for this category is VIM, Vanguard High Dividend Yield ETF. Why VIM? VIM focuses on US companies that pay higher than average dividends. These aren't speculative growth stocks. These are established businesses generating consistent cash flow. Here are the numbers that matters. Expense ratio 0.06%, just $6 per $10,000 invested per year. Dividend yield around 2.9%. That means every $10,000 invested could generate roughly $290 in annual income without selling a single share. On top of that, the ETF price has gained around 16% over last year or over the year of 2025. The payout frequency is quarterly, provides regular income, perfect for reinvestment or supplementing cash flow. How this ETF behaves. During market downturns, dividends ETFs like VYM often fall less than pure growth ETFs because mature companies tend to have more stable earnings. During rising markets, VYM may underperform high growth ETFs like VUZ or SPMO because mature companies grow more slowly. Over the long term, dividends provide both return and emotional support, helping investors stay invested during volatile periods. Think of VIM as the shock absorber in your portfolio. It won't make you rich overnight, but it reduces the risk of panic selling and provides steady income along the way. If I have to again talk about few key takeaways, VIM is not about explosive growth. It's about reliability and income. It reduces portfolio volatility, acting as a counterbalance to VUZ and SPMO. Dividends also allow for reinvestment, which compounds returns over decades. Combined with growth and momentum ETFs, VIM keep the portfolio steady without sacrificing long-term upside. Later, when I reveal the exact allocations for aggressive, balanced, and income-focused portfolios, you will see how VIM's income component helps smooth returns and provides cash flow depending on your risk tolerance. The fifth category, enhanced income strategy. This is the category where income focused investors lean in. While growth and momentum ETFs focus on long term capital appreciation, this ETF focuses on cash flow and smoother returns. My pick here is JEPQ, JP Morgan Nasdaq Equity Premium Income ETF, a covered call ETF tied to the Nasdaq 100. How JPQ works. JPQ uses a covered call strategy, which means it owns a basket of Nasdaq 100 stocks, tech heavy growth companies like Apple, Microsoft, and Nvidia, sells call options on those stocks to collect option premiums, uses the premiums to pay monthly income to investors. In simple terms, you trade some upside potential for smoother returns and cash flow. Key numbers and metrics: expense ratio 0.35%, that is $35 per $10,000 invested per year. Distribution yield 7 to 12%, varies with market volatility. That's roughly $700 to $1,200 per year for every $10,000 invested. Monthly payouts make this ETF ideal for reinvestment or supplementing cash flow. How JPQ behaves in different markets. Bull markets, gains are slightly limited compared to a pure growth ETF because call premiums cap upside. Flat or choppy markets, this is where JPQ shines. The premium income cushions returns, sometimes outperforming traditional growth ETFs. Bear markets, downside is still present. You are exposed to the Nasdaq, but the income from option premiums reduces effective losses. Think of JPQ as a stability and income layer for a growth heavy portfolio. It's not about maximizing returns, it's about managing volatility while getting cash flow every month. Some key takeaways: JPQ is ideal for income focused investors who want monthly cash flow. It trades some upside potential for smoother returns, especially helpful in choppy or sideways markets. When combined with VOO or core, VUZ or growth, and SPMO or momentum, it reduces portfolio volatility while still participating in equity growth. Monthly payouts allow for automatic reinvestment or supplemental income, helping compound wealth or supplement cash needs. Later, when I reveal the exact allocations for aggressive, balanced, and income focused portfolios, you will see how JPQ can significantly stabilize returns and boost income depending on your risk tolerance. The next category is non stock diversification. This category exists for protection and balance. So far, I have talked about growth, momentum, and income, all of which are equity heavy. That's great for long term returns, but it's also risky. Non stock diversification is about hedging against what stocks can't protect you from, like inflation spikes, currency fluctuations, geopolitical uncertainty, and stock market drawdowns. My pick here is GLTR, Gold, Silver, Platinum, Palladium ETF. How GLTR works. GLTR holds physical precious metals in one ETF, which are gold, silver, platinum, and palladium. Unlike mining ETFs, GLTR owns the actual metals, stored safely and audited regularly. The idea is simple. When markets get chaotic, these metals hold value or even appreciate, protecting your portfolio from downside risk. Well, in the year of 2025, there was insane appreciation of about 95%. Yes, you heard that right. The investment in this ETF almost doubled in that year, or in the year of 2025. Let's look into some key numbers and metrics. Expense ratio $60 per $10,000 invested per year. Asset backing 100% physical metals, fully audited. Holdings 4 primary metals. Now let's see how GLTR behaves in different markets. When stock market crashes, gold and precious metals often rise or fall less than equities, reducing overall portfolio drawdowns. Well, that was the exception in 2025. Inflationary periods, like in 2025, precious metals are a proven hedge against inflation. Their prices often rise when the dollar loses purchasing power. In stable markets, GLTR may underperform equities, but it does its job as a risk balancer. Think of GLTR as the shock absorber and insurance policy in your portfolio. It might not always drive huge returns, but when other assets wobble, it keeps the foundation steady. Some key takeaways: GLTR is not a growth engine, it's your safety net, but recently it has worked as the growth engine. Physical precious metals have low correlations to stocks, reducing overall portfolio risk. When combined with growth, momentum, and income ETFs, GLTR smooths portfolio swings and protects wealth. Even a small allocations, for example, like 10%, can significantly reduce downside risk without majorly impacting long-term returns. Later, when I reveal portfolio allocations, you will see how GLTR works as the stabilizer, complementing all other ETFs. The final category is global diversification. This category exists to solve a very common problem: home country bias. So far, most of our ETFs focus on the US market, which has historically performed well, but no single country outperforms all the time. Global diversification gives your portfolio exposure to different economic cycles, access to emerging market growth, currency diversification to reduce reliance on the US dollar, and a buffer against unexpected US market shocks. My pick here is VXUS, Vanguard Total International Stock ETF. How VXUS works: VXUS provides exposure to over 8,000 companies outside the US, covering developed markets like Europe, Japan, Australia, Canada, China, and emerging markets like India, Brazil, etc. It excludes US companies, so it truly adds international diversification. Key numbers and metrics: expense ratio 0.05%. So that is only $5 per $10,000 invested per year. Extremely low for global exposure. How VXUS behaves in different markets. When US is strong, VXUS may lag slightly due to slower growth abroad. When international markets lead, VXUS can outperform the US, capturing opportunities that domestic ETFs miss. During US downturns, international exposure can reduce overall portfolio losses, especially if other countries are stable or rising. Think of VXUS as the global hedge and growth booster. It adds exposure to companies and trends that don't exist in the US, helping your portfolio capture the full global growth story. Key takeaways: VXUS reduces reliance on the US market while providing global growth potential. Low cost, highly diversified, and globally weighted. It's an essential portfolio stabilizer. Even a 10 to 15% allocation can significantly enhance long term diversification, especially when paired with US focused ETFs. Now, when I reveal the exact portfolio allocations, VXUS will show how international exposure smooths returns and captures growth outside the US. Now that you have seen every category and why each ETF earns its place, here is the part I said I would save till the end: the actual allocations. There is no one size fits all portfolio, so I'm going to show you three versions depending on your risk tolerance. The first one is aggressive growth, higher risk, higher volatility. This version is for investors who can handle swings and want maximum long term growth. In your screen, you can see I have listed all the ETFs that I mentioned in this video and also their allocations. So you can see the weight of these ETFs in your portfolio if you want to have it in the aggressive growth. If you want, you can pause the video and look into the allocation yourself. So why does this work? Heavy growth exposure through VUG and SPMO, lighter income, and still enough diversification to avoid single sector risk. The next allocation is balanced, which is growth plus income. Again, you can see all the allocations on your screen. This is the version most long term investors can consider. Why this works? Growth fuels returns, income smooths volatility, and diversification protects against market surprises. Now, let's look into the third type, income or defensive. Again, you can see in your screen how the different ETFs are allocated. This version prioritizes cash flow and capital preservation. Why this works? Higher dividend and covered call exposure reduces drawdowns and increases monthly income. These are example allocations, not financial advice. Your age, income, time horizon, and risk tolerance matter. But now you understand how to adjust one ETF portfolio for completely different goals. Let me know your thoughts on this portfolio and allocations in the comment section below. If this framework helped you think differently about ETFs, hit like. Comment below which category you want me to deep dive next. And please subscribe. Your one click on subscription button helps the new channel like this grow faster. Thank you, and we'll see you all in the next video.